SK Hynix is no longer a simple semiconductor growth story. This is now an AI memory dominance bet priced for near-perfect conditions. The company is printing massive profits because the AI boom created a severe shortage in DRAM and NAND, and especially HBM memory. But the real question is not whether SK Hynix is strong. It is whether this strength is structural or just the peak of a brutal cycle. The business is exploding. March quarter revenue reached 52.6 trillion Korean won with operating margin hitting 71.5%, both massively ahead of expectations. Conventional DRAM and NAND prices surged far faster than forecast, while HBM pricing stayed strong because supply remains tight. Cash flow is also improving sharply, helped by extreme pricing power and hyperscaler demand for AI data centers. The big shift is simple. SK Hynix is no longer being driven by standard memory cycles alone. It is being powered by AI infrastructure demand. That matters because current profitability is extraordinary, but also clearly tied to scarcity. This stock looks expensive. Morningstar fair value sits around 1,030,000 Korean won, while shares traded near 1,840,000 Korean won, implying roughly 1.8 times fair value. That means investors are already pricing in extended AI demand, elevated memory prices, and stronger than normal margins. The current business is extremely profitable, but the valuation assumes those conditions stay strong much longer than a typical memory cycle. If supply normalizes faster than expected, the stock can re-rate hard. So this is not a cheap semiconductor recovery play. This is a premium AI cycle bet. SK Hynix is becoming an AI memory leader, especially through HBM chips used in advanced AI servers. Strategically, that makes sense because HBM is higher margin, harder to scale, and tied directly to Nvidia-led infrastructure demand. The company moved early, invested aggressively, and built real short-term advantage. But it is also risky because memory remains a commodity business. HBM leadership helps, but it does not automatically create durable pricing power. The strategy is logical, but investors should not confuse temporary technological leadership with a permanent moat. The biggest pressure comes from Samsung and Micron. SK Hynix currently leads in HBM and has captured major AI-related demand, which gives it stronger near-term profitability. But Samsung is catching up in next-generation HBM4, and Micron already proved it can re-enter aggressively after skipping prior cycles. In standard DRAM and NAND, competition remains intense and products are still heavily commoditized. SK Hynix is strong today because it moved first, not because competitors are weak. That distinction matters. The thesis breaks if AI infrastructure demand cools, if hyperscalers slow spending, or if supply catches up faster than expected. Memory is notoriously cyclical, and pricing can collapse when capacity expands. Chinese players also create long-term risk by improving quickly and adding industry supply. Another major risk is assuming HBM margins are permanent. If Samsung, Micron, or future Chinese competitors narrow the gap, SK Hynix can lose pricing power fast. This is a high-quality operator inside a highly unstable industry. The upside is clear if AI demand remains structurally stronger than expected. If hyperscalers continue aggressive data center expansion, HBM shortages persist, and SK Hynix holds leadership into future generations like HBM4, then revenue and margins can stay elevated far longer than the market historically expects from memory businesses. Success here looks like turning short-cycle memory exposure into a semi-structural AI infrastructure profit engine. If that happens, current valuation can still work. SK Hynix is no longer a cyclical value semiconductor stock. It is an aggressive AI infrastructure trade wrapped inside a historically volatile commodity business. This stock is for investors who believe AI demand will stay unusually strong and that SK Hynix can defend its HBM lead longer than the market expects. The upside is real, but the margin for error is thin. Great company, dangerous valuation. I'll break down the next one soon. Subscribe if you want to stay ahead.